All right, welcome everyone. Thank you for joining us as we get into a discussion about post-pandemic business recovery. Today, we're going to cover a couple of topics.
Of course, Joey froze. There, you coming in?
Am I
Hey,
back?
Joey, we froze after covering a couple of topics. Go ahead.
All right. CEBA loan repayment and then finding liquidity in your business. I'd like to thank the Chamber for providing us with the opportunity to present. My name is Joey Zanni. I am a licensed insolvency trustee with MNP here in Thunder Bay. And on the call with me today is Yohaan, who I will pass over to so that he can introduce himself.
Hi there, how are you? My name is Yohaan Thommy, and I'm a partner that leads our consulting business in Ontario and Atlantic Canada. I asked him specifically, and I say I'm from Toronto. I live about an hour out of the city, and my ties to Northern Ontario is I married a Northwestern Ontario gal from Red Lake, so spent a lot of time in Thunder Bay and Northern Ontario on client work and personally. It's an honor to be here. I don't get to tell her I told her I'm servicing some Northern Ontario clients today, and in her mind, anything south of Thunder Bay is Southern Ontario. So it's good to be here.
All right, thank you. So MNP is a full-service firm alongside our traditional assurance, accounting, and tax groups. We have a comprehensive range of services that we offer. I'm a member of our consumer and corporate insolvency group, assisting individuals and businesses struggling with their debts. We also offer core consulting services, along with digital and HR advisory services, among other offerings. We are a national firm with professionals located across the country. In Northern Ontario alone, we have offices located in Kenora, Fort Francis, Thunder Bay, Sudbury, and Timmins. For the agenda today, I'm going to give an overview of the CEBA program and where we stand today. We will cover repayment terms and the path to loan forgiveness, and then I'll hand the baton to Yohaan, who will take us through a discussion on finding liquidity in your business. So just by way of background, CEBA was a federal initiative that offered interest-free loans of up to $60,000 to Canadian small businesses and not-for-profit entities. Came out during the height of the pandemic and was meant to help small businesses survive and help cover either payroll costs or other non-deferrable expenses. Loans were administered through financial institutions, and uptake across the country was huge, with the initial offering being accessed by almost 900,000 businesses across the country, and the $20,000 expansion loan being accessed by 571,000 businesses. Total loans issued through the program amounted to $49.2 billion. The loans issued are partially forgivable if paid on time. The original deadline for repayment was December 31st of last year, but this was bumped to December 31st of this year and has been pushed back slightly again to January 18th of 2024. Loans not fully repaid by January 18th will lose qualification for forgiveness and will convert to an interest-only term loan, with interest being charged at 5% per year and the full amount being due December 31st, 2026. So obviously we've got a huge amount of money outstanding, and we've got some fast approaching deadlines. So where do we stand today? The Canadian Federation of Independent Business, their fall update came through with these statistics. They're a little bit gloomy, and I think it really shows that businesses haven't been able to recover from the pandemic. So to the fall, only 18% of businesses that access CEBA have fully repaid their amounts owing. 7 out of 10 haven't even started repaying. And out of that 7 out of 10, we've got roughly 1/3 that are going to be able to pay, 1/3 that are going to have to borrow to pay to access the loan forgiveness, and then a further 1/3 that don't have access to funds and probably aren't going to be able to pay. So literally hundreds of thousands of business without the cash to pay off the loans. There's literally hundreds of thousands without access to cash to pay off the loans, and they're up against some pretty tight deadlines right now if they want to access the forgiveness benefits of the loans. And we have our key dates noted on the next slide. So by this point, all businesses should be aware of whether or not they qualify for loan forgiveness. This notice should have come from the financial institution that they obtained the money through. For those not qualifying for forgiveness, the repayment deadline is December 31st, 2023. If you're unable to repay by that deadline, I recommend that you contact your financial institution to discuss what the next steps are going to be. Loan holders that meet the CEBA eligibility criteria are eligible for a January 18th, 2024 repayment deadline. March 28th that you see on there is a grace period extension. So if you've made an application for refinancing the loan by January 18th, but you require more time in order to pay or in order to finalize the payout of the CEBA loan, you can still qualify for partial loan forgiveness as long as the amount is paid in full by March 28th. And then the final deadline that we have indicated there is December 31st, 2026. And this is for those that, either chose not to or were not able to repay the loan by the January 18th deadline. These loans are going to be converted again to a 3-year term loan with interest-only payments. The balance to be paid in full by December 31st, 2026. So how does forgiveness work? CEBA went out in 2 different payments. So we had the initial loan that went out of up to $40,000, and then we had the second expansion loan of $20,000. The loans are forgivable at different rates. So the initial $40,000 is forgivable at 25%, and the expansion loan is forgiven at 50%. So if you borrowed on the initial round the full $40,000, a payment of $30,000 would be required, and the remaining $10,000 would be forgiven. If you borrowed the full $60,000, the payment of $40,000 would be required to satisfy the debt, and $20,000 would be forgiven. A couple of important notes here. If you want to access the forgiveness, you have to pay the full amount of the debt less the forgivable portion. Okay, otherwise nothing is forgiven. It's also important to note that any forgiveness that you receive is a taxable benefit. Okay, so we suggest talking to your accountant about the effect on the business. How can you pay? You have a few options in sort of this realm. Savings is the most obvious. So if you have the cash to be able to do it, you can take advantage of the forgiveness and eliminate any interest costs moving forward. So if you have the cash, that's probably the best source. And then there's a couple of options that you have that you should discuss with your financial institution. Okay, so one is a business line of credit. A business line of credit would have the advantage of providing flexibility in payment structure while also gaining the benefits of the forgiveness, provisions of the loan. A term loan would do the same thing and give sort of the same advantages as far as being able to access the forgiveness, but it'll give a set schedule and repayment timeline. Okay, and then the other option there is you just allow it to convert to the CEBA term loan. So you don't pay, allow it to convert to the term loan, service the interest, and then try to whittle away at the principal balance over the 3-year period. The interest rate is going to be lower than you would get on the term or the line of credit, and the interest-only payments could benefit you if there's an issue with cash flows in the business. On the next slide, we have an illustration of this. So one column shows an example of a business taking a 5-year term loan to take advantage of the forgiveness amount. So assuming the business took the full $60,000 CEBA loan, borrowed and paid $40,000, and then $20,000 was forgiven, with 10% interest over a 5-year term loan, the total cost at the end of paying that loan off would amount to about $51,000. If the same business were to not pay in January and just allow the loan to convert to a 3-year term, paying interest only, and then somehow paying the full principal at the end, the total cost would be $69,000. But let's face it, if you're only able to make the $250 a month interest payments while you're going through over the 3-year period, the likelihood that you're able to come up with a $60,000 lump sum at the end, it's pretty unlikely. So I think there's a material benefit to trying to make the payment before the end of the forgiveness period. Non-payment and servicing the interest, at the reduced cost could provide some, maybe short-term cash flow benefits. But overall, I think there's a benefit in paying the loan off on time. So next steps. I think the most important thing here is you talk to your financial institution and get clarity on forgiveness eligibility for the business and what your repayment options are. See if you can work with them on a refinance or what the options are around that. Second thing you should do is talk to your accountant about tax implications, okay? The third thing you should do is if you have any outstanding questions, call CEBA and, go to them with any general questions that you have. And then lastly, if you're unable to pay, and if you have questions about, your ability or desire to continue operating the business, please reach out to an insolvency trustee to discuss options. Initial consultations are always free, and we can chat through the options about, how do we wind the operations up, any potential personal liabilities that may come from the business, and then, any other potential issues that could arise. I'll pass off to Yohaan now.
Thanks, Evan. Really appreciate that, and a lot of learning from me as well. So thank you. Always appreciate doing that. I guess I want to talk to you about finding liquidity in your business and sharing some trends, some things that we're seeing in the economy, some things that clients are struggling with, and I'm actually going to talk about it through an example here. This is a hypothetical company, Ben Construction Company. I know that there's a few restaurants as well on the call, so I'm going to give you some examples from that sector as well and what we're helping our clients with. So this is Ben. Ben is 55 years old. He's an owner operator, and he's run his business for a couple of decades. He's looking at the volatility ahead. He's looking at the cash flow issues, inflation, and a slowing economy. And that is concerning Ben. Ben runs a $5 million business. And, if you run a business that's smaller or bigger, I think these numbers can scale up and down. It's just an example. And Ben makes 10% EBITDA. EBITDA is earnings before interest, taxation, depreciation, amortization. So you take your net profit and you just add back what you're paying in interest, add back maybe your computers or your equipment that you're amortizing. So he makes about $500,000 a year free cash flow on $5 million. Now, this is what's going on. I think emotionally in Ben's mind, cash is starting to get tight, and a lot of these government funding programs that were initially available to Ben gave Ben a little bit of a lifeline, but now Ben is wondering how to come up with cash in the business as things are starting to slow down. Ben's also not sure about what he's doing well and wrong. Things grew business-wise during the pandemic. Sales were up. You couldn't keep up in some occasions, but now things are starting to slow down. He knows he's not doing well in certain areas, but doesn't really fully understand where what. Is not getting maybe monthly reports as he should, and not sure how to make the big decisions. I find the other thing that Ben is going through is he looks at the next 5 or 6 years as being tough years. Now, I think there's opportunities in tough years to do well and make money, but also in that time, it's emotionally difficult. He also needs to find a way to retain his employees, and costs have increased. So rent has gone up, interest rates have gone up, raw materials gone up, gas, wages. It's interesting. I was looking at a number the other day, and Colliers put out a report, and they were studying the Greater Toronto area. I haven't seen a report right now in Thunder Bay, but they said pre-pandemic average real estate cost for industrial space was about $11 a square foot pre-pandemic in the GTA. It's now about 19 to about $23, right? So it's almost doubled, and that has an impact on costs. So before I jump into some solutions and some industry stuff, I just want to talk about, well, why are we doing this? Ben started a business to create value. So, he hopes that the business is worth something and he can sell that value. So how are businesses typically valued? And so you have the cash flow element, but then you also have, let's call it your wealth account, right? Which is, what are you building this business for? So this is a very simple linear example. I mean, if you want to talk about what your business is worth, I would say, we would need to have an offline discussion because every business is different, but this is a very linear example. So Ben makes $500,000 in EBITDA, and let's just say the multiple in Ben's industry in terms of what people will pay for that EBITDA is 5. 5 is generally a number we see in construction. It's usually about 3 to 8. So if you sell the business, Ben would have gotten $2.5 million. Except Ben has some special talents. And Ben has relationships with builders. He has relationships with customers. He is an amazing person to work for. People love working for Ben. So what happens is that a certain amount of the goodwill is owned by Ben in his mind and through his talent. So if you're buying Ben, well, how much of that leaves the business? In my hypothetical example, about 20% leaves. So if I bought the business, I don't have the same genius and creativity as Ben. So I'm not going to make 500 a year. I'm going to make 400 a year times 5. So the actual value of the business is about 200,000. But if you can actually move the goodwill from Ben's brain over to the business such that the business runs on remote control, well, then you can actually sell the business for about 2.5 million. Now, I want you to see these numbers and keep them in the back of your mind, because here's what's happening in the backdrop from an economic climate standpoint. It's not affecting every sector, but it's definitely affecting more sectors that it isn't. Number one, there's lower spending. Lower spending equates to lower overall revenue, and while each business differs, maybe their suppliers are struggling or their customers are struggling. We're now starting to see that kind of impact most businesses. About a year ago, I'd say, some sectors started to feel this crunch. Now I see that most sectors are feeling this, and then this relates to slower payments. So your cash flow, maybe it was you were getting paid every 45 days. Well, you're now getting squeezed a little bit more, and you're now getting paid every 55 days, and so on and so forth. Maybe there's some bad debt in the business because a client didn't pay you. There's also inflation. So inflation can erode margins pretty significantly. It's interesting. I always use the concept of the rule of 72. So you take 72 and you divide it by the inflation rate. It shows you how long it's going to take for your money to be worth half of what it is. And so, 72 divided by, if you take 4%, just as an example, help me out with the math here, Joey. I should have done it, but it's about 17 years, right? I think we'll trust the CPA in them. So it's about 17 years, which means that every 17 years, your costs are going to double in the business, and/or the value of your money is going to be halved. And we've seen some pretty high inflation, rates over the last little while. So last thing are interest rates. So, as all of us are living through it, the interest rates have gone up incredibly high. And many businesses rely on debt to finance the operations. I'm going to be talking about this financial piece moving forward. And it leads into financing. So the other piece is most businesses in most sectors are today worth less than what they were worth in January 2022 or before. Why is that? Well, because liquidity and access to cash to buy these businesses has gone down. It's followed what's actually happened in the real estate market, right? If for those of us that live in a house, we couldn't believe what our houses were worth, in January 2022, and then it kind of, for most of us, it went back down again. So, well, why is this? Well, because access to cash, leverage that the banks are willing to lend, all got competitive. That's going to start happening, and it's already started happening in business. I'm going to show you through a mathematical example how that's going to impact you moving forward and what you can do to sidestep it. So let's take Ben's, and I'll go really slow here, because not everyone's a math person like Joey. Okay, and I'm not a math person, so I'll explain it to you in a non-math kind of a way. But Joey here has revenues of $5 million. Joey paid $293,000 in rent, and his other expenses were about $4.2 million. Well, because of that, you deduct 293 and 4.2 million. Joey made about on EBITDA, or let's call it free cash flow, of $500,000. He had some materials, he has some equipment. The government lets you amortize that. CRA lets you amortize that cost down, so you pay less tax on taxable income. And so his pre-net tax profit was about 256. He works really hard for this money. He's made a lot of sacrifices. Now, it's interesting, he was paying 2021, he was paying 1173 a square foot, and he had about 25,000 square feet. Now Ben Construction Company, his rent has jumped to $18 a square foot. And if I just take this one example, okay, and I know not everyone's rent has jumped, but if it hasn't, it's going to, right? And if you own your own building, well, your mortgage payments are going to go up. So in some way, this is going to affect you. If you're someone that has lots of cash in the business and your building's paid for and you own it yourself, well, I think this example is still relevant because it's going to impact your customers. It's going to impact your suppliers. So now what happens is, let's just say Ben, 2 years later, has fought really hard, and Ben still maintains a $5 million revenue. Well, if all things are the same, and he still makes the same amount of profit, his rent expenses jump from $293 to about $450,000. And again, this example is scalable up and down. I mean, Ben's revenue could have been 500,000. Ben's revenue could have been 50 million. The example jumps up and down. Ben's EBITDA has now dropped to about $349,000. Why did he lose about $150,000? Well, because his rent ate that profit up. I'm not including the price of gas. I'm not including interest payments to fund I'm not including all of that stuff, which also has an impact. I'm just talking about one issue here, rent. But you can certainly add this to your business. And I would encourage you to sit down and even just guesstimate, well, what are the added costs of running a business today versus 2 years ago? And scenario plan it and figure out what the added costs are going to be, 2 years from now. I think that's a great thing to do, to figure out, maybe you want to talk to Joey about it, to say, hey, does it still make sense for me to operate my business in the same way, or even operate this business at all? What am I doing it for? I think that, I don't mean to be so grim, because I think that there are some opportunities, because most businesses now are making less money on a cash flow basis. And if this is true, they're now worth less. Because remember, I said that his business was worth 5 times. Well, 5 times 500 is 2.5 million. 5 times 350, that's not even, that's 1.8 million or thereabouts. So in 2 years, just because rent has increased, profit's gone down by 61%. Now, it's interesting, most banks in this country and credit unions are cash flow lenders. Some lend on asset-based lending. So if you own inventory, they may finance your inventory and your AR. Some of you may use a factoring company, but I'd say the large population of companies are cash flow lenders. Sorry, are cash flow borrowers, and banks are cash flow lenders. So that means that if Ben makes $500,000 a year of profit in his company, a bank will generally come to Ben and say, Ben, I'm going to lend you, and this is for illustration purposes only. Please don't go to your bank and say, MNP told me I can get 4 times EBITDA. Please don't do that. This is just an illustration. But if you are going to tell your bank that, you can tell them that Joey Zanni from MNP told you that. And so the bank will generally lend you 4 times 500,000, which is about $2 million. Now you may look at that and say, $2 million, oh my goodness, that's a lot of money. Well, $2 million on a $5 million business covers about 146 days of the cash cycle. How did I get that number? I took 2 million, I divided it by 5, it's about 40%. And then I took 40% and I multiplied it by 365 days, right? And so it's about 146 days. Well, now what's going to happen, folks, is we all know that the EBITDA has now dropped to 349. And what's happened is that the banks are now coming back and saying, well, hang on a second, the business is worth less. There's more risk in the economy. We know that there's going to be slow payments. We want to cover some risk. So maybe the bank in this example here drops to lending at 2.5 times EBITDA. And what's happening is that 2.5 times 350,000 is only about 875. And so you're looking at this now, and the banks are getting a little bit nervous on companies that are fully extended into their lines. And so $875,000 in this example only covers 64 days of cash. Now, if you're a construction company, and for those of you that run a products company where you're selling to other companies, you know that you have, or the restaurants over here, you need to have a certain amount of inventory of of ingredients, of maybe a fresh produce at the back. If you're a construction company, you're typically billing on a 45-day progress billing method. If you're a restaurant, you have Moneris, or maybe you have a credit card system, and you're getting paid in a certain amount of days. And then you're extended a certain amount of terms. You're getting paid in a certain amount of terms. I would say the restaurants are probably going to be less impacted. The construction companies are going to be more impacted, because the construction companies get paid by their GCs in some cases in 45 to 60 days. So these companies need 135 days of financing. Well, guess what? They've gone down from 146 to 64 days. Now, I don't want to be the messenger of grim news here. I actually think that there's a silver lining in this rainbow, because those companies that can cash flow plan really effectively and look at their operating cash flows, not just cash flow, but operating cash flow. How long does it take for me to, when I put cash out, to actually getting it back in, and calculating that? You may have to do that by different line of business. Those businesses stand a lot to gain, because you're going to see businesses that are going to be unable to take on contracts. They're going to be unable to expand, because they don't have the cash flow in their business. So what are some recommendations? Number one, focus on margin. So is there some way for you to drive more margin in your business? I do this example. I drive my wife crazy, and she's a Red Lake gal, and every time we're in Red Lake, I play this game. I go to a restaurant and I say, hey, I don't know if I should get the chicken or the salmon. What should I get? And I usually get the person that's waiting on us that says, you know what? I think you should get the salmon. The salmon's amazing. In fact, my uncle who looks just like you likes the salmon, so you should get the salmon. Well, part of the decision, if you want to be a restaurant, you're service-based, absolutely. I think the salmon and the chicken should be really good if you put it on the menu. But you want to sell the product that you have the best gross margin, right, on. You want to sell the product that maybe requires the least amount of hand time, right? So chicken, generally speaking, you make better margin on the chicken. Why? Well, because the input cost, the raw material cost, the food cost of salmon is high, and there's only so much that a customer will bear. So unless you can get it back and charge more money, well, if you charge double the cost for the salmon, then I might not get dessert because it's a bad economy now. And you know what? I'm choosing to eat my dinner, not drink it with maybe a port wine at the end, or coffee at the end, or cappuccino. So a customer will walk in and say, this is the amount of money I want to spend at your restaurant. Well, how do you make more dollars go to the bottom line? So thinking about, specifically, number one, bringing your cost under control, thinking about where you can lower your expenditure. But then lastly, even thinking about the products and services that you sell and where you make the most gross margin and how to convert it to cash quicker. I think the next piece is operational efficiencies. And, you're going to have to figure out a way, and I challenge all of you to do this. It is not easy, and I'm not saying it is easy, but, how are you going to gain efficiencies in your business, regardless of what business you run, that will at least outweigh the inflation cost in your business. So if inflation is affecting you, and all of our businesses are different, if inflation is affecting you by 6% or 3%, 5%, well, how are you going to get that back? So number one, are you getting the most out of your invested capital? Those machines you have, are they generating cash for you? Is it possible to take one of those machines and sell one of those machines, convert it to cash, maybe pay off your CEBA loan? What are the key drivers of productivity in your business? And how do you, I think in a environment where it's difficult to still find labor, is there a way for you to drive more productivity? Can you perhaps get things off your menu that take a long time to serve, that take a longer time to cook? Are you making enough margin on that product, as much as you were before? And I think the difficulty is this. I know all of you are brilliant business people and work hard in your business, but I can tell you what I'm seeing with my clients is that with inflation and costs and interest being changing so quickly in rent, it's very difficult for companies to continually cost out exactly how much money I'm making on each SKU, on each dish, on each line of service. but I think it's a worthwhile exercise. I think the last piece is enhancing cash flow. So what I would say is, you know, if I buy that jacket, that if I'm a distributor and I buy that jacket that Joey's wearing right there, which is a really nice jacket, Joey, you know, I may sell that jacket for 20% margin. So maybe the jacket costs $100 and I make 20% margin on that jacket. So I make $20 on that jacket. And my jacket isn't as nice, Joey. Okay, it's not as nice as yours. I bought mine at Winners, and my jacket may cost $50. It's half the price, and I make 15% margin on my jacket. So I make less margin than I make on Joey's jacket. Well, the difference though is that if I'm a distributor selling jackets, if this supplier that sold me this jacket gives me 60-day terms, and this supplier isn't hounding me, but Joey's supplier is, and they want cash up front, or they're willing to give them 20-day terms, you need to actually calculate what that additional gross margin is worth to you, because you're not borrowing to pay it, and you need to figure out how quickly you can convert cash back into cash. If you don't figure this out, what's essentially going to happen is you're going to get caught in that liquidity trap that I showed earlier, where your lines are going to be cut. So you have to figure out how to run your business with less money. So what are some things that you can do? So our recommendation, and I believe these slides are going to be forwarded over to you. Number one, do an operating cash flow analysis on your business. So important. If you don't know where to start, or you don't know how to do this, or you're way too busy, give us a call. We're happy to help you. We have a tool that, you know, I think we just need some numbers and we can plug it in. Number two, in my example of Ben, where he's making $350,000 a year and his line drops to 875. Well, what if you go into Ben's business and find another what if you doubled his EBITDA? His EBITDA was 500, and you double it, you take it to $1 million, and then it goes back down by 150 because of additional rent. Now Ben's EBITDA is $850,000. If you're borrowing at 2.5 times, well, you're still going to be, you know, thereabouts to the 2 million. So there's a way to fight this by getting more EBITDA. I think a lot of our clients increased prices initially because they were forced to. And I think that card has been played. There's very little more price increases, I believe, that the Canadian consumer will take. People are now getting, you know, pushed back on those. I think the other thing we need to do is rationalize your product. You know, stop selling Joey's jacket. You may be making money on it and better margin than Yohaan's jacket, but you're not getting any terms on it. So why don't you sell more Yohaan's jacket and see if you can increase your margin on that? Next, improve cash management in the business. Look at it like very simply, folks. If I can just share this with you, every day, look at a number and say, how much cash came in? How much cash did I pay out? Right? And how much cash over the next 5 days I'm expecting to receive and pay out. Just look at that on a daily basis, and you're going to learn stuff about the business. You're going to figure out how to control cash better in your business. Maybe go out and negotiate better terms. And then I would say build a war chest, right? You're going to need more liquidity. I am seeing this already happen with companies that maybe had a June 30th year end. They finished it. They came to their accounts. They came to their accounting firm. Maybe they came to MNP. We finished their year ends by September, October. We submitted it to the bank, and the bank's now coming back and saying, hey, you know what? We were lending you 3 times your EBITDA. We were lending you $1 million, 500,000. Well, it's going to have to go down by 20 or 30%, sometimes more, because there's higher risk now. We see your profitability slow down, and we're cash flow lenders, so we're lending you based on how much cash your business is generating. So I want to leave it at that here and just open it up to some Q&A, but I'll share this with you. If you want to pull out your phones, there's some stuff on our website in terms of some operational health checks. We do, you know, you scan it and it kind of gives you a little bit of a qualitative score on your business, depending on what you are doing and what you're not, and a little bit of a client testimonial of ours. But I'm going to hand it back over to Joey here and John from the chamber.
Yeah, for sure. So obviously, if anybody has any questions, they can just ask them, or if you want to message me for some reason, I can relay that to the MNP folks here. I did have one question, if that's if that's okay. I was just wondering, so I know there's been changes with CEBA. What do you think the chances are that it ever gets changed or extended again into the future?
I think if it was going to get extended, it would have been done by now. I mean, we had an update in the fall, and there was no mention of it. So I think any extension, it just would have been announced, right? We're coming up on December 31st as a repayment deadline. So, I think anything could happen, but I think if you're sitting there and looking at having to make this payment, you should be planning for January 18th as sort of the day if you want to qualify for that forgiveness.
Okay, definitely. And then just because it might apply to a couple people in the room, does anything change, I guess, if the ownership of the business has changed hands? So I guess it could be one way or the other if you took over a business or vice versa. How does that affect the CEBA?
Go out of your way. I mean, I could figure it out. It's just like it's been
Yeah,
a
so
while.
that depends on the structure of the sale, right? Whether or not it was an asset sale or if it was a share sale. So I think the prudent thing to do in a situation like that would be you get a copy of the loan agreement, and then you take that loan agreement down to your legal counsel and have a discussion with them on where it's at.
I want to share an example of a client of mine. He came to me and he was worried about the CEBA loan payment about 2 months ago. And I asked him why he was worried about it. And he said, listen, my business is generating less cash. He is in the insurance business. So he runs an insurance brokerage, a small insurance brokerage. I think it's about 7-8 people. One of the things that I advised him to do, and he took advantage of it and thanked me for it later, was I said to him, and I'll change his name, because if you look me up on LinkedIn, you'll find him. I'll change his name. I'll call him Bob. And I said, Bob, what are some really big capital costs that you're going to have to put out? And he said, Yohaan, I've got to spend a lot of money on some CRM software. I've got to spend some money on some cybersecurity software that's becoming an issue in my industry. I've got to spend some money on new computers. I've got to digitize my client experience a little bit, and maybe upgrade my system and my payment processing and all of this. And I said, well, how much do you think you're going to spend? And he says, I don't know. I think I'm going to have to spend about 10 to 20 grand a year for the next 5 years in order to stay relevant. And I want to automate some processes. And one of the things, and he says, why are we talking about this? I'm asking you about CEBA. And I said, well, hang on a second. I said, look, there's a really neat government program called CEDAP. And essentially most Canadian businesses qualify for it. You've got to be a Canadian controlled private corporation, CCPC. You've got to have more than $500,000 in revenue in any of the last 3 years. You've got to be for profit. You've got to have between 1 and 499 employees and under $100 million in revenue. And so I shouldn't say most businesses qualify, excuse me, I take that back, but a lot of businesses qualify. And what he did was he was able to apply for the CEDAP grant. He gets a digital roadmap for his business. He engaged MNP to do that, and essentially 90% of the cost was covered. It was about we charged him about $16,000. He got $15,000 back from the government, and then he got access to a BDC loan, which was $100,000 interest free for 6 years. Now, what he did was he had to pay for some of these digital costs in any case, and he used the loan amount to start paying for that, and the money that he would have taken from his business operating line to otherwise pay for this digital transformation in his business, he was able to take some of that money and devote it into CEBA. So that is a great option. And CEDAP is one of those loans that's accessible for most businesses. So just throwing that out there. And happy to, if you reach out to me or Evan or Joey, we'd be happy to share more information about CEDAP.
I do have maybe one more question. So if maybe since taking out the CEBA, if the business closed in that time, what happens to it then?
Okay, so again, that's one of those questions where I think in that specific situation, reach out to me as a trustee. It's going to depend on whether or not it was a sole proprietor or a corporation, right? If it's a corporation, the corporation's inactive, there's no assets in it, and you've got no plans to continue operations, then realistically, and if you have no personal guarantee on it, then really you don't have to do anything, right? So, but if you're looking at a situation where there's a personal guarantee, or you were operating as a sole prop, then whoever signed or whoever the sole proprietor is going to be liable for that CEBA loan, right? So you got to have plans in place to make that payment. And if you're not going to be able to make that payment, then maybe you reach out to us as a trustee and we chat about maybe a consumer proposal or maybe a personal bankruptcy or what other options may exist, right? Maybe it's a refinance on the house, whatever. But it's one of those things where I think it's going to be dependent on the circumstances, dependent on structure, and dependent on the document that you signed. So reach out if you need clarification.
Okay, thanks. That's all the questions people have sent me, and don't see any more in the chat. So just want to thank you guys again for doing this presentation. Really appreciate it. I know a lot of people are struggling with this, so thank you.
Thank you, everyone.